السلام عليكم.
وعليكم السلام ورحمة الله وبركاته.
السلام عليكم. Can you hear me?
وعليكم السلام ورحمة الله وبركاته. Yes. Audible. Alhamdulillah.
I will just wait for a minute or two and then we'll begin, yeah? If anyone wants to join.
Yes, no problem.
Sorry, I'm having a bit of connection issues. I'll leave and join back. Right. Can you hear me?
Yes. No problem.
Hello, can you hear me?
Yes. It's audible.
Are you able to hear me?
Yes.
All right. Sorry, I was having a bit of an internet issue. I
Okay.
think it's better now. All right. Okay. I'll share my screen and we'll begin. So today we'll be covering topic 11, which is liabilities, and then we'll be doing a couple of questions as well. All right. Okay. All right. Can you see my screen?
Yes. Yes.
All right. Okay. So the topic for today's class is liabilities. I'll just go through a quick explanation and then we'll begin, inshallah. All right. So the so what is a liability? A liability is an obligation to make future payments. So anything that that the company owes to us, another, whether it is a loan, whether it is trade payables, whether it is long-term loans, short-term loans, anything that they will need to spend money on now or in the future, when it's a liability, right? So there are multiple types of liabilities. So there are current liabilities. Current liabilities, a good example. These are liabilities that the company should pay them off within the next 12 months. This is called current liability. Current liabilities and current assets both are all the liabilities or assets, within the next 12 months that the company it has. Like, when it comes to assets, it's like cash, trade receivables, and so on and so forth. With regards to current liabilities, it is trade payables and other current liabilities, because these stuff the company needs to pay within the next year. Non-current liabilities is anything that the company has to pay off or beyond those 12 months. And good examples of this is bonds and other non-current liabilities. There are so many examples that can be given. Long-term loans, and different commitments that the company may make. If it extends beyond the 12-month limit, then it becomes a non-current liability. Then we have stuff like provisions, contingent liabilities, contingent assets. Provisions is basically for example, if a company if a company has an ongoing court case, right? So, and they have an ongoing court case, and they like, there's a table. This is not really, you don't need to know the specifics of it, but it just, if you understand the terms, it's good. So let's say there's an employee suing, a former employee suing the company for $50,000, right? And the company believes that there is a very good chance that the court will rule in the favor of the employee. So that means they will have to pay the 50,000, but they're not sure yet because the court has not made that ruling. So then they might make a provision for 50,000 dollars, because they believe that they will lose the case. If they don't lose the case, well, then they will remove that provision. So they will remove that liability. But if they end up losing the case, then they just have to deduct that liability, deduct that what they have, the provision that they have given for the employee. So this and the you don't need to know about in detail, but it's just an explanation of the term. So provisions, contingent liabilities, contingent assets, all of them are of the similar type, based on the probability of whether they need to pay something or not. They're not yet sure about it. The company will keep like an allowance, for that. All right. So with regards to liabilities, another important factor is the amortization table. So the amortization table is very important with regards to how you amortize bonds. So a bond, what a bond is maybe a company needs money, and right, so then they issue a bond for maybe 300,000 ringgit, and then somebody will take that bond and they will give the company money, and then after 4 years they will have an interest period, interest amount, a percentage every year, as well as they will have an extra amount that the company is to pay when they're repaying the loan. So bond is a type of loan, and there is something called amortization of the loan as to how it is paid back. And for this, there's something called an amortization table. I wanted to use the slide that you have. Like it's shown pretty clearly here, how you calculate the amortization premium And how you calculate this. So first you have the carrying amount in the beginning of the year. So the actual value of the bond, what the company received, the money, and then you have the finance cost. In the question, you'll be given a percentage, and then you have the interest expense. You'll be given a percentage, right? Actually, this is better. Yeah, you'll be given a percentage, and then you have to find the carrying amount at the end of the year. This is what will go into the financial statement. So so you have to we'll apply this table in the question on the left, but this is just the I'm explaining to you where it's coming from. So besides that, I think there's nothing else to really explain about. You have to go, if you go through the slides and all that, you will get a better picture that you have. And once we do this question, inshallah, you can get a better idea of how it works. All right. So let's move on to the question without further delay. All right. Okay, so we have the company. All right, so let's look at the question. So at the beginning of 2016, the statement of financial position of Emerald Berhad is as follows. So cash, assets, cash, and other assets. Okay, we have this, and then we have shareholders' equity, ordinary share capital of 5 ringgit each, 200,000 authorized, 80,000 issued. So the meaning of this is that the company, they have been authorized, or they have been given permission by the government to issue 200,000 shares, but they have only issued 80,000. So 80,000, and each share is worth 5 ringgit. That is the price, the value of the share. So 80,000 into 5 ringgit is 400,000 ringgit. Okay, and then we have 4% preference share capital of 10 ringgit each, worth 50,000. Okay, that is there. And then they have share premium 39,000, retained earnings 332,000. This is the financial statement as at the beginning of 2016. So the question is essentially to do with adjustments. You have to add these. So here, if you see here, it says the following transactions occurred during 2016, but have not yet been recorded. So the question is essentially saying that you have to make these adjustments to the financial statement, and then eventually at the end, as a requirement, you have to journalize each transaction, and you have to also prepare the statement of financial position at the end of the year. All right. So let's journalize these transactions, and then we can solve the question that way. All right. Okay. So part A, we have okay. So here we have debit. Okay. Okay, so the following, so on January 1st, the company issued 10% 4-year bonds payable with a 400,000 face value at the price of 440,647. The bonds pay annually on 31st December each year. The current market interest rate is 7%. Right. The first thing you have to do is you have to debit. You have to debit. Basically, the company has received 440,000, right? So they would have received it to their bank. So we can see, we can put cash, right? So we have here cash, debit 440,647, and then you put here 7% bond, credit 440,647. Right. So this bond is worth 400,000, but the company has been paid 440,647. So we have to put that there. Now we have to look at the amortization table that I showed you over here, right? So we need to get the like in the question, they ask us prepare the statement of financial position as at the December 31st, 2016. So we have this value, the carrying amount at the beginning of the year, which is 440,647, but we don't have this. And so to have this, you need to use this table, right? So let's just quickly do that, right? So we have year carrying amount you can just carry amount beginning. Then we have finance cost, have interest expense, all right, and we have carrying amount at the end of the year. All right, so all right, so one thing we need to understand is what is the finance cost percentage? The finance cost percentage is 7%, right? The finance cost percentage is 7% based on the question, and the interest cost percentage is given here, issued at 10% 4-year bonds. 10% 4-year bonds, right? Okay. Where's the okay, all right. So let's complete the table. We have it's a 4-year bond, right? So we have year 1, year 2, year 3, and year 4, right? So the carrying amount, like I said, is 440,647, right? And then you have this amount. This amount is the finance cost, which is which is 440,000 into 7%, right? Into 7%. So you get, this is the finance cost. Let's round it. The finance cost for the year. And then we have interest expense. Interest expense is, sorry, is 10%, not yeah. But the interest expense, the interest expense, for the interest expense, you do not take the face value. For the interest expense, you take the the par value, right? Which is 400,000. So you have 400,000 into 10%, right? And what goes to the carrying amount at the end of the year is this amount plus the finance cost amount minus interest expense amount. This is a formula. This is how the table works. To get the carrying amount at the end of the year, you have to plus the finance cost minus the interest expense cost, right? All right, and then so you can, and then what happens here is this will equal the ending amount over here, right? So this will be that. This will remain the same. Let me just So this is the table. This is the amortization table, and these are the amounts that will go on the financial statement at the end of each year. So at the end of 2016, which is year one, this is the carrying amount for the bond that will be mentioned on the financial statement, right? But then there's there's another important thing that needs to be added over here, right? It's called the amortization premium, right? The amortization premium is the difference between these two, right? So you have this minus that. Okay. All right. All right. Is this table clear? Do you have any questions?
No.
You studied this with your professor, right?
Yes.
All right. Okay. So this is the amortization table, right? And this is how you calculate the things, right? And the reason why this one is important, right? The amortization premium is because you need to have a journal for it. So now, on January 1st, right? We have the first expense, of course, is the first journal entry is debit cash 440,000 and credit the bond 7%. The next thing we have, right? The same one, we put finance cost, right? We put 30,845, right? And then we have this amortization premium. Basically, it's a 7% loan bond, right? We have 9,155. Then we have the interest expense. Have it here. So this is the complete journal entry for for this transaction. So there are two. The first one is straightforward. That is, you debit cash and you credit the bond with the company. What does the company receive? The second one, which is the finance cost and the interest expense and all that stuff. This one is a bit more. This one is a bit more detailed, you could say, and you have to do a bit of working. Just give me a minute, yeah. I'll be back. All right. Can you see my screen?
Yes.
Okay, so this is interest. It's called, actually, you should put interest payable, not interest expense. All right. So that is the first transaction. All right. And then we have the second transaction, which is on March 8th, right? We have paid interim cash dividend of 0.40 per share for ordinary shareholders, right? So it's important to understand the wordings in this transaction. So ordinary shareholders. So first of all, the value for ordinary shares is 400,000 ringgit, right? And 80,000 shares were issued, correct? So that means there are 80,000 shares and the cash dividend was 0.40 into per share. So we have to put 0.40 into 80,000, right? 0.40 into 80,000. Once again, it is the company receives cash, right? So 0.40 into 80, 0.40 into 80,000 is 0.40 into 80,000 is 32,000, and you credit ordinary. No, sorry, you credit dividends. Yeah, you credit dividend 32,000. You can just put this over here. 0.4 into 80,000 equals 32,000. So that is the cash dividend that was paid on March 8th. And then on November 15th, issued right issues of 1 for every 8 shares held at face value to existing ordinary shareholders. Once again, it is important to understand the terminology over here, right? So issued right issues of 1 for every 8 shares. So now there are 80,000 shares, 80,000 ordinary shares. So issuing 1 for every 8 means 80,000 divided by 8, basically 80,000 divided by 8, right? And that is 10,000 right issues. 10,000 shares have been issued, right? Because 8 first you have 80,000 divided by 8 equals 10,000 rights shares issued, right? And then you have, it was issued at face value, held at face value. So face value is the 5 ringgit, the value of it. So that equals 10,000 into 5, which equals 50,000 ringgit. So once again, cash is debited. Let's put November 15th. November 15th, right? Once again, the company receives 50,000 ringgit in cash, and what will be credited here?
Dividend.
Oh, sorry. I made a mistake over here. Over here, cash is credited, not debited, because the company is paying cash. Dividend is debited. Yeah, okay. Dividend is dividend is debited. Cash is credited because the company is losing money, right? They're paying more money. But over here in November 15, the company is getting money from their shareholders. So for that, they're issuing 10,000 more rights shares. So 10,000 rights shares for their ordinary share. So they debited 50,000 because they received 50,000 in cash, and they credit. You can put credit ordinary. No, ordinary shares. Because see over here, see what happened over here on the March 8th is that there are 80,000 shareholders. Let's take it as there are 80,000 shareholders, and each of them received 0.4 ringgit. So the company paid out 32,000 ringgit to them, and so then the cash was credited because they're losing money, they're paying off money, the company, and the dividend is debited. But in November 15, the company is taking money, so they are issuing shares, right? They're giving shares to people. They are giving extra shares to people in the company who already are there, right? And this is how they give them. So if you for every 8 shares, for every 8 shares that you own, right, you gain 1 extra share. You have the ability to purchase 1 more share, right, at the cost of 5 ringgit each. So if there were 80,000 shares, 10,000 shares, new shares were issued at 5 ringgit each, which is 50,000. So the company received 50,000 in cash, right? And the ordinary share value, so this value would become 450,000 because 50,000 extra. So it is credited further by 50,000, and in the same financial position, it'll increase by 50,000, right? Is that clear?
Yes.
Okay. All right. So then we dealt with November 15th, right? Next we have December 1st. December 1st. Propose a cash dividend of 0.15 RM per share to ordinary shareholders, pending for approval in the forthcoming AGM. What should be debited and credited here? Do you know? Do you know what should be debited or credited here?
Uh, 0.15 times.
No. Actually, nothing should. There should be no entry here because this has simply been proposed. It has not been implemented. You understand? So the transaction has not taken place. So if the transaction takes place and it's approved, then yes, 0.15 per share to ordinary shareholders. So on December 1st or at the end of the year, now there are 90,000 shares, right? Because to start off with, there was 80,000, and then 10,000 more shares were issued during the year. So there are 90,000 ordinary shares. So if they told here that a cash dividend of 0.15 per share to ordinary shareholders was given, then it will be 0.15 into 90,000. But this is just a proposal. It's not yet approved. If it's approved, then it's another matter, right? So there are no journals there, right? Okay. Then we have December 31st. We had paid preference dividend, and secondly, paid interest on bonds payable. So what is the preference? The preference share capital. If you look at this over here, preference share capital of 10 RM each. 10, that means one preference share is worth 10 ringgit, and the total value of the preference shares is 50,000. So if we divide 50,000 divided by 10, we get 5. So there are 5,000. There are 5,000 preference shares, each of them valued at 10 ringgit each, right? So now if they say, okay, what the 4% preference dividend means, 4% preference shares means holders of the preference share, they get a 4% dividend each year. So if the value of the share is 50,000, of the preference share is 50,000, we take 4% of that. So 4% of that would be 4% of 50,000. This would equal 2,000 ringgit, right? So we have over here. So then this is money is being spent, right? So we put preference dividend. We could even just put dividend, and we don't have to put preference, but just for the sake of it, I'm putting preference dividend to make it more clear. We can put here ordinary dividend, and we have 2,000, right? And then the company's losing cash, right? They're paying cash, so 2,000 money, 2,000 is paid out to the preference shareholders, right? But then they have another one here, paid interest on bonds payable. What is the interest on bonds payable for the year? According to the year, we calculate over here.
40,000.
40,000, right? Okay, yeah, that's correct. So we have, once again, cash. Let's put the cash first because we know cash 40,000 is credited because you're paying cash, right? And then here you have interest payable, debit that. You see over here, we had credited interest payable, right? So we said, okay, this is an interest payable for the year. And then on over here, we debited again, we credited cash, right? So these are the journal entries for this question, right? Now they say prepare the statement of financial position. So let's do that. So we put statement of financial position for Emerald Berhad as at 31st December 2016. All right. So now first we'll have, let's say we have assets. Right, so over here they have not been clear about what. Okay, cash is a current asset, but this one we don't know. So let's just we can just keep it as assets here. We don't need to go into more detail because they have not given us more detail, right? Okay, before we do the statement of financial position, we need to first make all the changes that were done over here, right? So the biggest, the one that had the most change really was cash, right? So let's create a small P account for cash, just to make it a bit clearer. All right. So wait. All right. Okay. So first of all, with cash, we have the brought forward amount, right? The amount that was brought forward at the beginning of the year, which is 325,000. This is the amount that was given to us. Can be seen over here, right? 325,000, right? And then we have the in the first entry, we have cash was debited by 440,647. So 440,647. We put it here 7% bond. Okay, that's the first general, right? And then the second entry, we have the cash is being paid ordinary dividend 32,000. So we put 32,000 ordinary dividend. Right, and then on November 15th, the company receives cash, right, by issuing ordinary shares. Okay, so the company receives 50,000, so it's debited 50,000 ordinary. Let's put SC, ordinary share capital, right? December 1st, like I explained, there's nothing, right? And then on December 31st, first there's a payment of 2,000 ringgit because the company pays the preference dividend. So 2,000 preference EV then, okay. And then finally we have the interest payable. The company pays 40,000 interest pay. All right. Okay. So now what is the total? Some and then here we have the carry forward amount. The carry forward amount would equal this minus these numbers, which is 740. So this is the final the cash value at the end of the year. Is that did you understand that? Is that clear?
Yes, yes.
All right. Okay. So that is the cash asset, right? Okay. All right. So let's move on to the statement for financial position. All right. So we have cash. Cash is 741,647. Then we have other assets equals 536,000. Okay. And then we have total assets equals sum that amount, right? That's the assets. And then we move on to liabilities. Okay, so what do we have as liabilities? All right. So here there's nothing to do with liabilities. Right? We have we have to look at our we have to look at our journals, right? And yeah. All right. So our journals say over here that we have the 7%. 1 minute. Yeah. Yeah. So we have a yeah. All right. So in our liabilities, we have the 7% bond. Oh yeah. Sorry, I forgot this. The carrying amount end. I was confused. So the carrying amount at the end of the year is 431,492. 431,492. Right. And then we have the amortization amount. The amortization amount. This amortization amount is 9,000. This also goes as this is also a liability. Right. We have the amortization. Right. Is 9,155. Right. And then okay, so those are the only liabilities that we have. All right. Those are the only liabilities that that is there. Okay. Then we go to the equity. Then we have total liabilities equals sum, this amount. All right. And then we have equity Okay, so then we have ordinary share capital of 5 ringgit each. So now this would of course change, right? Because over here, as can be seen, it starts off at 400,000. But over here, we have an increase of 50,000 in the share capital. So ordinary share capital is now 450,000. All right. Okay. And then we have preference share capital of 10 ringgit each. There was no increase. There was no increase in preference share capital. Yes, there was a dividend paid out, but that was it, right? So the actual equity, actual preference shares remains the same. $50,000. And then here we have a share premium. There was nothing to change that. That also remains the same. 39,000. Retained earnings also. There's no change to that. Okay. All right. So total equity equals sum Okay. So we have total liabilities plus equity. There's a small discrepancy. One second. Why is this? There's a small discrepancy here, which I'm not certain why exactly that is the case, to be honest with you. A minute, let me just look at this for a moment. Okay. There's a small discrepancy here. I'm a bit confused by. All right, but did you get the general idea with regards to this?
Yes, yes.
Okay, I need to look into this a bit further. I'm a bit confused as to why it's not matching. It should match. Okay. All right. Okay, we'll cover this. I'll look into this a bit further, inshallah, and then I will make a short video regarding. But the majority thing is fine. There's a small discrepancy because this amount, see, this amount is 84,000, 74,000, right? And that is the discrepancy between these two. I'll look into it a bit further and see where the error is. But the general working is fine. Yeah. All right. Okay. So did you understand the question one? How is the do you have any questions regarding anything else besides this, like this last part with regards to how I generalized it and how I and made this change and all that stuff? Is it clear?
Yes, it's clear. There's no question about it.
All right, that's great. Alhamdulillah. Okay. Mhm. I made a, yeah. So when you pay off dividend, right? When you basically the dividend that you pay, right? The company pays this amount from its earnings, right? So if the retained earnings of the company was 332,000, right? They pay the dividends from it. So this amount needs to be reduced. So retained earnings would equal, right? Would equal 332,000 minus, what is the, it was 32,000 and 2,000, right?
Yes.
32,000 minus 2,000, right? So this would equal how much? 300, this should equal 298,000, right? So this would actually be 298,000, all right? And then another thing that we have, another liability, right? Is this interest payable. This also needs to be added. This is also a liability for the year. This 40,000 needs to be added as an interest liability. No, I mean this needs to, this needs to be minus because I mean, yeah, sorry, this interest was actually paid by the company, right? So this needs to be minus. Yeah, my bad. Yeah, because this interest was paid. This reduces the liabilities of the company, and if you then once we do that, the total assets equals the total liabilities plus equity, and that fulfills the requirement of the accounting equation. Right. Is that clear? Do you have any? Are you clear on the changes that I made, like why the retained earnings changed, and also with regards to interest payable?
Yeah. So interest payable should be always negative.
Well, in this instance, actually, in this instance, yes, it needs to be reduced because it was paid by the company, right?
Okay.
Just put interest paid. It's better. That's a better better word to use. Interest paid. If it was not yet paid by the company and the company still owed that interest, then it would be a positive liability. It's because it is payable. But now that it has been paid, right? The cash amount has been reduced. The liability also needs to be reduced. All right, is
Okay.
that clear? Okay,
Yes, yes.
all right. Uh, I'm sorry. This is once again, it's another mistake here. No, actually, it's not the. No, I'm making this stupid mistake. Yeah, it does not need to come as a liability. It will actually affect. Once again, it'll affect the retained earnings, right? Because this is how it works. This is how it works, right? So this retained earnings value, right? This value we get it through the statement of profit and loss, correct? So the statement of profit and loss, it takes the revenues minus the cost of goods, right? At the end, it gets the the gross profit, and then it minuses the interest, it minuses the dividends, all of that, and eventually you get retained earnings, right? So even the interest that you pay, you need to reduce it from the earnings. It's not added as a separate liability. This is the statement of financial position. So the retained earnings was 332,000 to begin with. We reduced the dividends paid out and also the interest expense because retained earnings is basically the earnings for the year. You understand? So the
Yeah.
earnings for the year that you have remaining at the end of it. So the interest expense is reduced from the retained earnings. Yeah, I'm sorry for the confusion. So yeah, so this 40,000 would be over here, and this would be 258,000. Yeah, this would be the correct one. I mean, the thing is, there's a for the retained earnings to make it clear. It's easy if you make a table and then you minus each like thing that needs to be reduced from it, you reduce it. But I did not I did it directly, and that's why I made that small error. Anyways, now both of them match, and the answer is clear, right? Is that clear? Any question regarding it?
Yeah. There's nothing.
You
So
got it, right?
we just need to create a table for retained earnings for assurance.
Oh, I'm sorry.
Regard,
What?
I mean, we need to have a T account with regards to retained earnings for us to be assured.
You can do that. But see, where is I think in one of the earlier classes I had. Let me.
So
Which one was
is
that? Maybe let me just see. I think it was this one where I had created the SOCE, the statement of change of equity. In that, usually, it'll all be. Let me just see if it's here. Oh yeah. For example, like this statement of changes of equity. All right. So we have the retained earnings. Like you basically you'd have it like this because if you had this, so you'd have the retained earnings as at January 1st. At the beginning of the year, our retained earnings was 300 in this question. It was 332,000 at the beginning of the year, right? And then during the year, so typically speaking, you would have this value, profit for the year, because see this value, this 332,000 is given in the beginning of 2016, but now they have not given us the earnings for the year, so we don't know what the earnings for the year is. But how is the profit for the year calculated? Within this value, within the profit for the year value, the interest expense is added, is minus. So you have the revenue minus the cost of goods, right? And also then you minus interest expense to get the profit for the year. You understand? So the interest expense is subtracted over here from the January 1st retained earning value. Okay, correct? And then you also remove the dividends. So for us over here, we don't have they have not given us information regarding revenue and all that stuff. So we just need to directly from the retained earnings. From this is the January 1st retained earnings, 330,000. So we remove the dividends, we minus the dividends from it, paid 32,000 minus 2,000, and then we minus the, essentially this 40,000 is the profit for the year. Profit for the year is minus 42,000, because we don't know the revenue. We don't. They haven't. Maybe this company doesn't have. They did not give us the revenue as of this one. They did not mention it, and so we need to minus it. Essentially speaking, the profit for the year in this instance is minus 40,000. So if we were to create the statement of financial equity, this will minus, it will be 330,000 minus 40,000, and then minus 32,000 minus 2,000. And that way you would get 258,000. Is that so? Yeah, is that clear? Do you understand now why I minus the interest from the retained earnings?
Yes, yes.
Right?
Yes, it's
So
clear now.
essentially it was part of the profit for the year, but they have not given us the revenue and all that stuff. So using that way, I completely, when I was doing it first, I missed it by mistake. Anyway, I think it's clear now. Alhamdulillah. All right. Okay. Okay. So now the second question. The second question is very similar. Right. Let's just go through. I don't think. Do you think we should do the whole thing, or shall I just like explain it a bit and then complete it? What do you prefer?
Just brief the
Okay.
discussion.
Yeah, so I'll just discuss the question a bit, and you can try doing it by your own. If you have any issues, I can do it next class, or I can help you out directly. All right. So this question is very similar. So we have the statement of financial position of Sapphire Berhad, and then we have assets. The cash is 412,000. Other assets 981,000. This is fine. And then over here, like the old question, we have ordinary share capital, 2 ringgit each. 500,000 authorized, 300,000 issued. So you can see 300,000 into 2 is 600,000. Then we have 5% share capital of our ringgit, our 4 ringgit each. So how many preference shares are in existence? If the value is 200,000, 200,000, one is 4 ringgit, right? So 200,000 divided by 4, that is 50,000 preference shares have been issued, like at the beginning of the, before the question starts, right? And then we have share premium 150,000, and we have retained earnings 443,000, right? So this is very similar in terms of the makeup of the question. Then we have issued 8% 5-year bond payable with a 300,000 face value at the price of 282,413. The bonds pay interest semi-annually on 30th June and 31st December each year. The current market interest rate is 9.5%. Okay, 9.5%. So this is very similar. Let's just make the amortization table for this, just as an okay. For example, if you make the amortization table for this, right? So the carrying amount, all right, the carrying amount to begin. First of all, this has 5 years, right? Insert. Right, so this is 5 years. So the carrying amount to begin with is the amount that the company actually received. Even though they issued a 300,000 bond, they offered it at a discount, where they actually received, the value of the bond is 300,000, but the money that they received was 282,413. So everything changed because I had connected it, right? But then over here, the problem is this. So the finance cost is actually 9.5%. And the interest expense of the actual bond is 8%. So here we have 300,000 into 8%. Okay, and then over here we have J36 into 9.5%. All right. Okay. And over here, the reason why, one of the main reasons why I wanted to do this was, see, this amortization premium is always the difference between these two. So if this is greater, you take finance cost minus interest expense. If it's the other way around, it's the other way around. So over here, in the last question, the interest expense was greater. But here, the finance cost is greater. So you do that. And this one would equal that. Okay. By the way, this value, this the reason why this should be 300,000 exactly, because that is the actual value of the bond, right? So at the end of the 5 years, the value of the bond, like, it should be reduced. It should equal the par value, just 300. But this is because of rounding. You know, we have I'm rounding a bit due to these values over here, and therefore it's not, you know, coming exactly 300,000, but that's the actual rate. It's a minor discrepancy. But this is the table for the amortization table for question B, right? For question 2, for this bond, and then you know, the way we did over here, we would have, you know, cash 282,000. We'll have, you know, 8% bond, 200, 430, and then we'll have the finance cost. So then the finance cost for year 1, the finance cost will be 26,829, right? And then we have interest expense, and we have amortization premium. Over here in the second question, this amortization premium will be credited, because over here the amortization premium is less, right? So we'll have interest, interest payable, basically 24,000, and we have amortization premium, which is this amount. Where is it? 2,829. All right, so that would be this one. And then on January 12th, you know, like the previous question, we have issued 50,000 ordinary shares to the public for 8 ringgit per share. So 8,000 into 8 into 50,000, which is 400,000. And of course, you know, the company incurred 6,000 on the cost of issuance of shares. So this is a very basic, you know, stuff to add to the journal, to journalize, and then eventually to create the financial statement of financial position. Okay. So over here, for example, in this question, unlike the previous question, it says a cash dividend of 0.20 ringgit per share to ordinary shareholders was approved and payable on January 31st next year. So unlike this question, where it was up for approval, here it was actually approved. But the difference is, but the thing is, even for this question, you will not add any entry, because it is payable on January 31st of next year, not in the year that the question is about, which is 2016. So once again, you wouldn't have to worry about it, but it's, you know, they just try to confuse you. So it's important to you know, just take care of that. All right. Okay, so do you have any other big question with regards to any other doubt, significant doubt with regards to this question? If not, we can wrap up.
Nothing so far.
All right, so try doing this question. All right, try
Yeah.
doing this question, and you know, if you have any further doubt with regards to it, let me know. Inshallah, I'll help you out.
Inshallah.
Okay. All right then,
Inshallah.
inshallah. Okay. Assalamu alaikum.
Alaikum salam. Jazakallah khairan.
Yeah.